Helpful if folks sit a little closer tonight so we can have a little roundtable discussion. I think it'd be great. Yours on?
Now it is. Thanks.
Yep.
Yes. Hello, 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 hello.
Sick.
Cool. You turn off music.
Yep.
Remember to do the welcome to the camera.
Yep.
And the close as well.
Cool.
Which.
We should just sit here, Corey, and talk to ourselves.
100%.
Just have a private conversation.
That's right.
Just the two of us.
Just the two of us.
We can make it if we try.
Just the two of us. You and I.
I do love how even when there's only 20 people here, half people won't sit down.
That's right.
Never
Come
never
on
change.
down.
We're consistent.
Come on down. Lance Harris. Come on down.
It's always our favorite people that are in the back of the room, causing trouble every time. Come on down. Sit up close tonight, man. We're gonna have a little round table.
Yeah.
Yeah.
No cool kids in the back.
Nathan, you can't sit behind the column. I'm gonna need you to talk sit a little closer because I'm gonna be calling on you.
We're
This
gonna
is
need
intentional.
you.
This will be a lot easier if we're all a little closer.
Bring it in. Bring
Yes,
it in.
I'm here for it, man.
Here we go.
Yeah, you can do whatever you want.
Yeah,
Move that
dude.
stuff around.
I love it. Yeah.
No. Dude, I'm... Are we live, Dalton? Live
Yes.
streaming? Hello to everyone that is at home that didn't venture out in the heat and that's melting right now. All right. Welcome to Grid Knoxville. This is July 2026, and we are talking about how to buy and hold the BRRRR strategy to build wealth. Is it dead? Is it still possible? This is the foundation of everything we do here at Grid. What's up, Corey? How are you doing?
I'm too blessed to be stressed, man. I'm glad to be back in the room. We're coming off of our anniversary party last month. That was pretty amazing. Did you guys have a good time? Who all came to our anniversary party last week? Yeah. All right. Good deal. Good deal. Right. So coming off of that, pretty fired up, but certainly glad to be back here in the room, continuing these conversations, these meetings, continuing to grow the community. It's good to see everybody out tonight.
I love it. If you're in this room and you owe property, I haven't talked to you, I'm telling you now, I'm about to call on you. So, hey, Rashid, you can talk tonight. And Parker, and we're going to have a little roundtable conversation about how to buy and hold, right? And I think what I'd like to start off with, if it's cool with everybody, then we can kick into the intros, but just kind of take the temperature of
Totally.
It's a small enough room. Like, what do you want to know? We can go deep on a lot of things. What I want to make sure we leave here with is that, yes, buying and holding works. It works in any market. The properties and the target and the strategy are going to change. Like what you should be buying and holding is going to be different market to market. But it is that's the key to wealth. That's where all the wealth is created, is buying and holding assets and sitting on them. It is not exciting, and it's not a coincidence that the richest people in the country, our president, God bless, right, made a fortune in real estate. Like holding real estate is a proven strategy to build wealth.
That's right.
Yep.
It totally works.
The funny thing about this is from talking to Rob, he said, really, we should teach this every single month, but no one would show up. It's not very sexy, so we get you in here with wholesaling and all this other stuff, and then you find out that you still have to just buy and hold assets, right? But today we're going to talk about buying and holding assets. So it's a presentation on why eating vegetables is good for you. Enjoy, right? But it is, if you're my age, you're like, actually, no, I do love a salad now. I got the itis because I had nachos. I knew better. Now I can't sleep. Like, I'm 43. I should know this. Anyways, Corey, what are you grateful for, man?
Yeah, man. Grateful to be back in the room. You said it's good to just continue keeping back in the rhythm of this, keeping to grow the community. So grateful to be back here today. Grateful to be in some AC right now. Actually,
I am too. Grateful for 5 years. We had a big month. Grateful we did GridCon. GridCon was super exciting. Lance and Cindy and Jeff got to come, grab Lance and just ask him what the experience was like. Really, really cool. It was cool to see this on a national level and to see the relationships, and we've got something really special. So really excited to hear that. If you've never been to Grid before, Corey, what is Grid?
Yeah,
man?
So Grid is we call it a global investor community that we like to bring here to hyper local level through meetups just like this. This is an opportunity for people across all demographics and spaces to come and learn and grow together. We oftentimes like to say we're never here to be just like gurus to kind of pontificate on high. We're just here to be real people doing our real deals in real time, sharing our experiences with you, and trusting you're going to share your experiences with everybody else here in the room, and we all get to learn and grow together. That is Grid.
Yes, just looking at this map here, St. Pete launched this last week. I was talking to Birmingham today. They're on the way for launching. We've got Chicago's launching some sub-chapters. So there's one coming in Kenosha, Wisconsin, and Northwest Indiana. Denver's stood up. The guy running Denver, really interesting. If anyone's interested in the senior living space, Vern is an expert on that. Vern Harris. So Grid is rolling out. We are the largest investor community led by agents in the world. Pretty exciting to see all the stuff that's coming down the pike. So, real fast, get into there. Who's got a win? Who's got something that they're celebrating?
I'm going to call.
What's your name, sir? Hey, Ophir. Welcome. Welcome to Knoxville.
Welcome, dude. Thanks for coming out.
You, separately from the investing, you've met some of my favorite people in town to hang out with, to spend time with, business owners, parents, great friends. You're in a good place, man. We hope you stay. Yeah, welcome. Glad you're here. It's a great win.
Welcome.
Who else has got a win? One more. Who's got something that happened this week?
Awesome.
Let's go.
Good.
Let's go Chaz, then Paula.
Chaz, and then Paula.
Sorry, go ahead, Paula.
Go ahead, Paula.
I love it.
Deal.
That's fantastic. Chaz, how about you, sir?
Your brother. Hey, congratulations.
Let's go.
I love it. Good
Fantastic.
deal. Joey. Hell
Let's
yeah,
go,
man.
Joey.
Congratulations. That's
All
awesome.
right. I got a win. I found out that a deal closed and there's a referral check floating around. So there's
nice.
five
money.
G's to go in the car. I was like, all right, there we go.
That. Yeah, a little mailbox money showed up.
Yeah. Yeah. You can tell who's organized and who's not in this relationship. So, poor Corey. All right, cool. Corey, who are you?
Yeah. So, my name's Corey King. I am the co-host here for Grid Knoxville. I'm also our team lead, team manager for our Casa Knoxville. That is our real estate sales team. I've been doing that here for, I guess, in the business now for 7 years. We've been running Casa for 3, which has been really cool. I started off actually just as a buy and hold investor. I bought my first property at 22, became the house hacker, rented out a couple of bedrooms to some of my buddies, used that to save my money and continue to grow and scale. And now I get to do my own buy and holds and fix and flips and co-host this, and that's me. It's pretty sweet.
Yeah, fantastic. And then Corey is a great sales leader. So if you're curious at all about the sales side of the game, we do a call every Tuesday. You can come in, you can call with us, see what it's like. Check it out. We're doing a business landing clinic. So if anybody is an agent, they want to come to that, we're doing that tomorrow. And you get 2 hours of continuing education, right? Excited to do that. So my name is Justin Myers. I am a serial entrepreneur, and I have tried to be an entrepreneur with no systems for many, many, many years, and have done everything. I've had 18 jobs. I started in real estate at the age of 23 as a mortgage broker. I run this team with us, and I get to do some cool things with Grid on a national level. Lead our podcast. We do a podcast every single Tuesday. that we've changed the whole format. So everybody here, we'll talk about it at the end, is invited. We're going to go through, Lance, all the 7 levels of freedom. We've totally changed this. So we're going to be going through these sequentially and breaking this down and interviewing like agents and investors and like covering every facet of the business. Really excited. We were doing this only for agents and changed the format there. They've asked us to lead that. I think it's going to be really, really valuable for you of kind of like walking through sequentially some of the stuff that we've been talking about one-on-one of like, how do I get from point A to point B, right? I want to buy and hold. Hey, how do I build up my cash machine? How do I get the reserves? The stuff we talk about in Investing 101, but everybody pouring in nationally and the national community is pretty impressive. For context, we're sitting there at GridCon. We bring in some amazing speakers. At GridCon, we're talking about private lending. Charlie is sitting there. Charlie has $40 million on the street, $10 million of his own cash. Started lending in 2007. Just the coolest, most down-to-earth guy. But, you know, the guy, we have Chris on there talking about his agent business. He's doing $12 million in revenue this year. So there's just some like levels to this, like that we'll be able to put together. So I'm pretty excited about that. All right. Ready to kick this thing off, man?
Totally, most definitely.
Sick. Okay, we'll come back to these here. Let's talk about who's in the room?
Yeah. Who are we? Who's in the room?
We got some new folks in the room. So we had Ophir. Who else is new in the room? I just saw Bart. Where you at, Bart? Bart, what do you do? So Bart does painting and drywall. Sick. We've got who's got capital in the room? Who's got some cash to deploy for a deal? Bart's got some capital. The 2 lenders don't have any money apparently. So sorry guys. The
banks are closed.
The bank's closed. We've got some capital. If you've got some capital, there's some pretty interesting private ventures. Corey's funded some stuff on some small stuff that could use some capital, some small deployments. Who's got a deal to shop? Anybody got anything they're trying to move? Yes. I have deals. I don't know about anybody else on the team, but I like selling real estate, so I've got some deals that make sense. Corey's got a really cool deal in Mascot that really makes sense for an owner occupant, but there's some instant equity, so there's some deals there afterwards. Who else had a deal? I saw a hand go up. Yeah. Ophir got some deals. Fantastic. All right, cool. Yeah, no big deal. Just a 10 cap in 2026. We're here to talk about buy and holding. Probably shouldn't talk about that one, Morgan. Fantastic. Tell us about the deal. $48,000 in gross revenue. Okay, maybe we'll break these numbers down here and we talk about how to buy and hold, and we can explain all those. If you're sitting here going, "What's a 10 cap?" I came to an Investing 101 meeting. We break it all down for you. But cool, that is an interesting opportunity. We should talk about that one. Corey, who else is in the room that I'm not thinking of?
Any other contractors? Anybody else who's a contractor in the room? Cool. Joey, what do you do? Most excellent. Do a damn good job of it too. Will, what's up, brother? What do you do?
All right. Daniel, we're going to get you up here in a second when we talk about property management. Ready for your close-up. Cool. All right. Legal stuff. Don't sue us. Don't invest money you don't have. All right. Like you can't lose money. All right, ready to sit? I'm going to kick this thing down.
Totally.
All right. Fantastic, man. What is let's break down buy and hold, like the way that you see it. Like what? Awesome. Perfect.
Yeah.
Walk us through this, Corey, because you're doing this. You're playing a little Mechanicsville Monopoly.
Totally. Yeah. I'm very much playing this game, right? Buy and hold is in essence a property that you plan on buying and sitting on for 12 plus months. Or in my case, I'm really playing a 10 plus year game. These aren't necessarily always going to be properties that you're trying to get rich off of and replace your income from certainly in like the single family space. That's going to be really, really difficult, and you're going to have to buy a lot of them to do so. Yeah. So in essence, like you're just willing to be patient with your money and be willing to wait a while, but it's going to be a nice nest egg and it's going to be a good inflation hedge.
Yeah. When we're talking about buying and holding, we're talking about pure investing, right? This is a wealth machine play. It's not a cash machine play, right? We the distinction being like the cash machine is the thing that I can do where I can turn that engine, I can turn that dial, I can generate more income at will. Every serious investor that we know has to have a cash machine. That cash machine could look like you've got a great W-2 and you make amazing money. You know what I mean? So that could be a cash machine. And if that's the case, that's fine. But for most of us, I got to do something entrepreneurial. That's what gets me in the room so I can buy and hold these assets for long term, right? And that's when we get into all the advantages, the tax advantages, right? The long-term value of this. And what we're really doing is playing like interest rate arbitrage. So the way to think about buying and holding is everything that I see like in the economy related to real estate really is some form of a buy and hold game. It's a spectrum, right? It could be a spectrum from, hey, I buy and hold this thing, and it's an STR, and it's kind of a very active thing. I manage it myself. I'm holding it long term. It's a combination. To all the way on the other end, it could be something like a triple net lease. We were just telling that story, Corey. Tell a story about the Tesla dealership down where we're from.
Yeah. So there's a guy who's been in the commercial real estate space for a long time, Ben Malla. I don't know if you're familiar with Ben or you follow that guy on YouTube. Great dude, been in the space for 30, 40 years. But anyway, he just bought a Tesla dealership in Titusville, Florida. It was like $2 million, right? But it was a triple net lease, meaning that the tenant is responsible for everything, the taxes, the utilities, the maintenance, etc. It's something he needed to do as part of a 1031 exchange. He needed to go park some cash. So let me just go park some cash and buy a Tesla dealership that's on a 15-year triple net lease from the richest man on the planet, right? Seems like a relatively like safe bet for him.
Yeah. And so everything else that kind of falls in there in the consideration of, right? When you look at even some of like the large scale, like insurance companies, Geico, et cetera, if you look at where they've got their money parked, a lot of them, they own apartment buildings. And from talking to the developers, I know the way they described it to me is even development is a buy and hold interest game. It's like, cool, here's the return I get, my long-term return on raw land. How do I develop this into, like, let's say Class A apartments? The long-term ROI on that's much higher, right? I'm getting a much higher return than I am than on the raw land. And the game just comes down to what can I borrow the money at? What can I deploy it on? Making money off of that margin, right? That's all that buying and holding is. The reason why buying and holding is so effective in residential real estate is the power of the 30-year mortgage.
Totally.
Right? We've got a 30-year fixed mortgage. It is incredibly unique. It is one of the greatest inventions that capitalism has ever created, right? And leverage. We have the ability, unlike lots of other things, I can show up here with lenders in the room. What's the lowest down payment I could buy an investment property with? Zero. What's a more, if I'm buying just a regular product, not getting too creative, what am I looking at minimums? Okay, so private money, 10% down. If I'm going with, let's call this conventional, not conventional, non-QM, QM, whatever, I can put down 15%, right, and purchase a property.
Here.
Yeah, everyone should be doing a house hack. What we're doing there is that I'm getting to go borrow this money. I get to hold this thing long term, 85% of this other money, but I get all of the appreciation on that asset long term. And I wish I had this thing. We do it in our Investing 101. But if you look at this, right, the equity appreciation over time is an exponential increase. Your payment on the mortgage, you're paying down the equity. So if you got a tenant in there, they're paying it down for you, right? And that's the magic, right, is the delta between those two things. Is that someone else pays this mortgage for me over time. This keeps appreciating. It's pegged to inflation. So the market goes crazy. That's fine. It floats, generally speaking, right? I've seen some exceptions, but generally speaking, real estate is a pretty safe place to keep some money parked, especially over a long enough horizon, right, Corey?
Yeah, I mean, it's part of why just being like having a primary residence, like in and of itself, is still can looked at as its own buy and hold game.
It's one of the strongest correlations to personal wealth.
That's right.
Yeah, despite what Grant Cardone might say, like just being a homeowner, and just because and why is that? Because we talked about this before. Finance is the study of money. Investing is the study of behavior with money. When people buy homes, they just tend to. We see this all the time as realtors. Like they tend to start behaving differently. Right? It's just a fundamentally different like approach to their community, to their. Generally speaking, when you're paying a mortgage, all of a sudden now you're like, oh, I've got opinions about the neighbor's grass that I did not have when I was renting. Like, you know what I mean? This is affecting my property value. What's happening in this town? We need some speed bumps. Like, no, it just affects how people show up. And we know that, like, you just see it across the board. People that own homes tend to be more engaged in the community. That's a general statement. I know tons of engaged, tenants and, right, they take amazing care of their place, but just generally speaking, right, we see people make different changes.
Yeah, you got skin in the game.
You're just thinking long term. There's lots of different. You're putting down roots. Just psychologically, there's a commitment there. So, what are the questions you have when you're thinking about like buying and holding? And I'm curious, what are y'all's questions about buying and holding? What are the questions we have in the room that want to get answered today? Is it going to cash flow? Right. So that's an interesting. I'm gonna come back to that one. Is it going to cash flow? Is one. Who else has got a question? We're not going to answer them all right now, but I want to poll so we can kind of nail the room. What did we come here to talk about today? Paola, what's your question?
So I know I hate it. Hello. Okay. So I hear a lot when people say, "Okay, buy a property." Hold it, get some equity, and then you grab that equity and you invest it in another property. And then it's like a cycle.
Okay.
So my question is, can you like dissect that in a more clear way of how to come about that?
So your question is you hear people say that you should buy rental real estate and then pull the equity out and rebuy rental real estate.
Yeah. Like how realistic is that?
Okay, that's good. Cool. There's some questions to answer before that. Yeah. If we answer the fundamental questions, it'll answer that question. That's the kind of thing you're seeing because a lot of people were selling this idea in an appreciating market that everyone should just buy doors, and they're selling all their shit because they were full of shit. Okay, like you buy doors without leverage or systems, you get screwed with interest rates, and we've seen this. Like, there's a couple of different anecdotes we could talk about afterwards. But yeah, you can redeploy capital, totally valid, if we have the fundamentals.
Yeah, just how to use my equity. Will it cash flow? So just deal underwriting.
Yep, and we've had people, like anytime you get in the market and people start talking about things like the market has fundamentally changed. We saw this in 2007. Property can never go down, and like in the early 2000s. I just am pretty skeptical of it because nothing changes. There's nothing new under the sun. You just find out this is the savings and loans crisis. This is crypto scams. This is I think knowing the fundamentals is very helpful, frankly. And if there's not like a free lunch in investing.
What else? Who else got a question?
Dave's got a question.
Do you feel like the buy and hold strategy needs to be changed for where we are in the market? Because obviously you're hearing a lot of people that are have huge portfolios that are selling their single family portfolios right now. And even like you were kind of talking about, if you want to eventually get something that retires you from your W-2, replaces your cash flow, you have to get a lot of doors. So kind of two-part question there.
Yeah. Do you feel like the strategy has to change? And is that like buy so many doors that I have enough passive income to live off the passive income? Is that like a realistic strategy? Is the second part of that. Going back to cash flowing is another one there. Good. Anyone else, anything else they're curious about here? I'm curious, what I came here today is like, hey, what are people doing that's actually working? Mm-hmm. How is BRRRR still possible? And yes, we have some stuff that works. Travis. I'm sorry, I can't hear. I don't speak Cajun.
Which May. Come on now.
Hey, by the way, did anybody get to try Travis's jambalaya?
Yeah,
right?
So good.
Was that not like honestly? My daughter had 5 bowls. I'm not even lying.
Yeah.
She asked Corey for one, and then she got too impatient. I came over. She had 2 bowls at once. It was absurd.
I carry my jambalaya well.
Yeah. No, but big thanks if you didn't get to try it. we're not exaggerating. Travis is an unbelievable cook. Cooked for 100 people. Thank you, Travis. Is amazing.
Yeah.
What was your question, sir?
Yeah, I just like expectations on what are we looking for on a cash flow? Like is there a number that you're trying to get from each home?
Okay, perfect. Okay, so I've got some. What I think would be helpful, Corey, is like if we talk about the fundamentals, all of this stuff will make sense. And when I share that is I remember I was talking to Rob Chavez that founded Grid one time. Somebody came to me. It was Christian Swan that came here to talk about commercial. If everyone was at that one commercial one like 3 years ago. Hotelier, amazing. And she was like, tell me about this syndication. And it was like a $14 million syndication. And it sounded very exciting and that she needed it. And I went to Rob and I was like, oh, blah, blah, blah. She's raising capital. It's a deal. And he's like, why is it a deal? Right? He's like, anytime that someone starts talking to you, you just flip it around and you go, explain to me in like plain English why this is a deal. And if they can't explain it to you, it is not a deal. And that it's not any different if you're dealing with 14 million, it's just changing a zero, and that it's all the same. Even on these big syndications or apartment projects, it's the same sort of thing, right? Class C going to a Class A, that's just like a fix and flip, right? Or if you're going to hold on to it's a BRRRR or forced to maybe there's a development play because you're going to build. It's not any different. Like these are all still the same fundamental plays. They just sound different because they're bigger. And so I think it is just like when you do this long enough, he's like, it's always the basics. It is always 101. And people get away from it. It's because they're not doing 101. You talk about how they lost money. It's because they went off their investing thesis. And at GradCon, we had some great conversations about this. I bought something that wasn't in my buy box. I went into this market I don't understand. And now I'm retrenching. Like it's always the same thing. That so much of what we do here is not sexy. It is just, are you disciplined enough to do the boring thing for like 10 years to have some success? So let's talk about the boring thing, Corey.
Samir, did you have a question? You got the mic.
Yeah, and I hope this makes sense. I don't even know if it makes sense, but how small does the difference between the ARV and the purchase price have to get to where the lender isn't willing to lend you money for that deal?
Can you ask that a different way? I think I understand what you're saying.
So let's say, like, usually for this, I'm looking at distressed houses that need a lot of renovation work. What if I find a house that needs very, very small amount of renovation work, like a few $1,000s? I'm guessing that ARV value isn't that different than the purchase price to where the lender would be willing to spot you 90% of that.
Okay, so we could start there with this one, Corey.
Yeah,
and answer a bunch of these things.
So as I heard that right, like if I found a property that is relatively close to what its fixed up value is.
Let's just say it's got no repairs.
Yeah.
Yeah, we're buying a move-in ready property, and the move-in ready property costs $200,000. So it's easy. Yeah.
Sure.
What does that look like?
Yeah,
And we can work backwards from there. Does that sound fair?
Yeah, like would I be able to put down 10% and the lender cover the remaining 90%, and then I can like refinance it in like a week after I get like a backyard fence in or something.
Okay. Oh, so BRRRR. You want to BRRRR this and get your money back out.
Yeah.
Okay. So two different. Let's start with the basic scenario. So we lay out some of the terms, Corey. Mm-hmm. LTV, ARV, whatever, and then we can just go into this one and talk about like what's the skinniest BRRRR you could buy, I suppose.
Sure. Yeah.
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 Yeah. All right. Cool. Generally speaking, we talked about this on the front end. Like, what are the basic things you need to understand before you can go buy and hold? The basic skill sets. One was understanding value.
Not only just like of like how do I run comps, but generally like how is this property like valuable to the neighborhood? What is the trends for the area? Like, what does any kind of future growth look like? What is my risk tolerance for this?
Yep.
There are properties that are out there that you can buy that will still cash flow really well, but they may be in like rural, poorly like developed areas, and so you don't really get this long-term equity gain, and your tenant base
or
might
even
not be
markets
as great.
like Detroit or like
Sure.
Cleveland or something where historically you haven't seen appreciation. Prices have stayed low, but they cash flow like crazy.
Yeah.
So one, how do I understand value? Just like what is a property worth? You know, am I buying a property? Am I getting any of it, sort of a deal there is one. Two, we talked about cash flow. When we talk about if a property is going to cash flow, we're only talking about two things, income and expenses. So let's start on the income side. We're talking about the rental side. You ready for your close up, Daniel? You want to jump up here?
Yeah,
Yeah,
come on,
man.
dude.
Here you go. Come on, join us. Who are you? Why are we calling you up here?
I used to be a dirty wholesaler. Now I'm a dirty property manager. Yeah,
Daniel-
someday.
Daniel owns. You probably have
I'm
to talk
married. I don't
right.
have to anymore.
You probably have to talk right into this thing.
Oh, right in.
Right in.
Sure.
Like staring down the barrel.
My
Yep.
McDonald's has my heart rate at like 120 right now. Maybe a little stage fright as well. I don't know, maybe.
Yeah. So Daniel is a property manager. Daniel owns Stonebook Property Management. So if we're talking about income, we're talking about how much rent is this place going to get, right? And how do we determine that? Like, let's just say I'm stubborn and I'm an investor and I think I can do everything myself. And later I'll find out I'm going to call Daniel. But at first I'm like, no, I can figure this out. How would I figure out what rents go for if I wasn't using a property manager?
The easiest hack that no one knows is Zillow for rent, like current market. Because when you comp a like flip, you're usually looking at like sold properties. And so all of you guys are obsessed with looking at history of actual completed sales. Well, you don't get that when you're leasing a property. You only have current market of what is like for rent. And most of you, when you're starting, you're probably going to buy something under 4 units, probably. And so on Zillow, when you look at current for rent units, all single family will show you how many contacts have been made during the entire listing of that rental. And you can see, because someone has it up for way too much, that there's been 0 reach outs, which is not even scheduled showings, which is not even applications, which is not even a lease that then was canceled by someone not moving in. So the sales funnel of that, I'm kind of a sales guy first, so I understand sales funnels. And so I go to what is for rent right now, and I look at how many people have reached out. And if I'm seeing over 20 leads or contacts have been made in a single 7 days of it being on market, I can tell that it's probably priced correctly. And then I can play the same game as a flipper and do the comparables, square footage, is it the same asset class, geographic territory, is the layout wonky or not wonky, and play the game without having, like, for me, we're like 390 units, so I have all that private data that I also know how my team can perform on it. So I kind of plug that data point in, but you can get 80 to 90% of what I'm trying to do by just going on Zillow and looking at what for rent and how many contacts have been made.
So there we go. That's one is, okay, so what's my potential income, right? Is I'm benchmarking that. I'm figuring out what the rentals are. There's a reason we have a property manager here. Like, most people do not love being landlords. So what we have
A lot of
seen.
people don't like you being a landlord either, I have found out.
Oh yeah?
Yeah, I'm a little famous on social media now because of
Are
that.
you?
Yeah.
Yeah.
People don't like other people investing into their retirement, and I just think that's very interesting to me. But
Yeah, I know.
don't stop. The American dream is owning part of your country.
People just are mad at the wrong rich people. That's my hot take. It's just a much smaller group for me.
Totally.
None of y'all. You're all good. Okay, so income, and the other part of this is expenses. And then we're going to come back and talk about tenants and leasing, right? So expenses, like, what are some of the biggest expenses of owning rental property? You, as a property manager, you're managing all those expenses on behalf of them.
I mean, your biggest expense is opportunity cost, which is like your vacancy. Your mortgage is coming every 4 weeks.
Yeah.
You better be ready. And it's something you have to hedge against.
Vacancy crushes rent, right?
Yeah,
like, if you have 1 month of vacancy,
8.3% of your year is cooked with 1 month vacant. So when you're looking at it, when we do our renewals, I look at, like, right now we're on a downward, if not paused market, just depending on like what our lease is on a specific property. So if I had been managing it for at least 1 lease previous, I'm probably trying to keep the rent the same, or I'm willing to go down. And my math is basically the break-even negotiation dollar for the following lease would be the same price as if it was vacant times market rate 11 months, if that makes sense. So I know I'm making money even though I'm dropping rent as long as I'm getting 12 of that on time over the following new lease.
Or another way to think about it would be I'm better off taking 93%.
Yeah.
Right? I bet you
Yeah.
93% of the rent's 1,000. I'm better off taking 930 and getting this thing under lease
In
than
this
sitting
market.
and waiting. And then I'm making, 91, right?
We have
91.50.
I have a client with 100 doors who's made a hard stop on any dollar increase. Like there's no, like I'm not even allowed to try to go get him more money.
Because he's more concerned about vacancy than he is
Yeah.
about increasing rent. Yeah,
Mhm.
that's fascinating. So that's one of the biggest ones is going to be vacancy. Then we have capital expenditures.
Yeah.
So capex is you'll hear called capex. What's capex, Corey?
Yeah, I mean that's just your cost of maintenance, your cost of operating it. The roof develops a leak, and I've got to switch that out. I've got a water heater that goes out every 10 years. I've got a tenant turnover that now I've got to go back and repaint the place, and those are just capital expenses that have to go in just to keep the property operational and maintaining.
Yeah. So those capital expenditures, the big ones are going to be, right, obviously plumbing, electrical, mechanical, roof. Those are the big ones that come on a recurring basis. And when you factor that in, you find out like sitting and get the free cash flow is challenging because you got the free cash flow and then you put a new roof on and you just wiped out
Yeah, you smoked a couple years
of cash flow, right, in terms of reserves. So income, expenses, cash flow, tenant screening is I think why, like, if I could think of one thing, it's tenant screening, maintenance requests, actually handling the accounting for this property. Like there's a lot that goes into property management correctly, but I'd say tenant screening is the single biggest one of like, if the property manager does a good job with tenant screening, you're like, why am I paying this person? This is anyone could do this. This is easy. If you don't do a good job with tenant screening, I have seen nightmares, right? Of you've got to replace the entire kitchen 3 years later. You've got to, right, Corey, like
bug remediation. I got to fumigate this whole house or something. Yeah, for sure.
My favorite one is when I was getting started 15 years ago, someone came in the office and they were having kittens because they had done a lease on the side, which you cannot do as a realtor. They had leased this property. The ATF raided this property because they were counterfeiting money in the master bedroom. You know how much fun it is trying to get tear gas out of your carpet? Woo! Yeah. Yeah, so she was freaking out about what's the liability for me placing a tenant in there as a counterfeiter. Yeah. You do this long enough, anything is possible, anything has happened. Any tips on like screening tenants, Daniel?
Income is your most important thing. I manage a lot of C-class, and C-class tenants are choosing your unit because of the price point. And so you have some of the most creative people on earth trying to move into those units, and you have to be okay with that being a C-class landlord. I'm not a magician. I can't find you 850 credit, $150,000 household income, and consistency in life. However, income is your primary thing that you're focusing on with your C-class. We do have A and B as well. But credit is what you, the landlord, ultimately, in my opinion, are accepting to be lower than if they were to purchase a home. So getting used to reviewing credit, and you will be shocked as a small landlord how low and how often credit can become. I sold cars for a year before getting into property management, so it was not a shocker. But the amount of 400 to 550 credit applicants that you receive makes you really realize like who's walking around and what type of stress they have in their life. And so income is where we like to really put our focus. If you want to talk on credit, I can, but ultimately you can get really tricked up on credit, you can see an 800 credit, and if you don't know how to review credit, you would not know that they were actually went through a bankruptcy less than 2 years ago, and it's like a rebuilt 800. And so the smarter you think you get with credit, the dumber decisions you'll make, where the income is where you can truly verify check stubs. If you're anywhere near January, February, you can get, maybe more in the spring, you can get their last year's taxes and really get an understanding. If they say they own their own business, I'm even calculating, if you want to own your own business and you only bring in $60,000 in revenue, a really good business is holding 50% of that. So I'm not counting 60,000 of personal income unless you show me a 1099 along with a little bit of a business plan that I can verify all of that coming into your home.
Everyone track why income's the most important thing, right? You can't squeeze blood from a stone. If they don't have income, you're going to be forced in a position where you're going to be dealing with evictions.
The amount of people I deny is, I really try to work with people, and I find myself somebody that I review all the applications, I sign all my leases as my principal broker, as my own principal broker, and the amount of times I have to tell my team, like, this person is not approved, and they just are like, but they said they're going to pay, like, it's going to be perfect, and it's like,
who's had to evict somebody in here?
Yeah, I was going to ask who's been to eviction court.
Yeah. Okay. So a couple of us. Yeah. It's not fun. I think I live in that world more than most of a lot of broke folks. Spent a lot of time with broke folks. Been a bit of broke folk many times myself. And no, it's not fun. And so we're not doing somebody a favor if we're signing a lease that they're not ultimately gonna be able to afford. It's not giving them a leg up. Now they are getting evicted, losing money. We're putting them in a worse position ultimately is what I've seen. And they would have been better off, finding something they could have afforded.
yeah. Like, people are always trying to bat up and increase their life. That's us as Americans. And it's, kind of your job to protect your own assets in that sense, because people want more than what they can have at all times typically.
Yeah.
Truly, yeah.
Anybody got any property management questions? While you have Daniel up here, by the way. Samir.
I'm going to put it right here, too. Talk right into the microphone.
On the flip side of the income estimate from Zillow, can you also rely on the Zillow estimate for the monthly payment before you to kind of calculate that profit?
Are you saying that there's a rental
The mortgage
comparison?
calculator?
Yeah.
No.
No. Okay.
It just, there'd be no advantage. You can just call your mortgage broker that's going to give you the money.
Okay. Okay.
And like, the money's not going to change on one 250K asset versus another 250K asset. The payment's going to be the same. The payment's not going to, the interest rate's not going to change based off of the asset.
Okay.
Generally speaking, if we're talking like single-family residence, it's not going to change based on this property versus this property as long as it appraises.
Yeah. The very...
You would disagree the rate could change? Yes, if it's the same asset class, I said. Okay. So if you're looking at no. If yes, to Nathan, it's the same asset class. For the rest of us, we understand single families are single families and duplexes are duplexes and triplexes are triplexes and quadplexes are quadplexes, and compare apples to apples.
And a single family, like a standalone single family residence being different from a condo or townhome, like in that category, I guess. Yes, they are all single family, and
but you could just
I think
sit
what
down.
you're talking about is like a, call it bricks and sticks, single family detached dwelling.
You would be better off having a conversation with a mortgage lender for a half an hour and ask him to price out 4 scenarios for you than like relying on like a random
that dude.
A random
Or
payment.
morning, right.
In my opinion, like, it's not that helpful.
Gotcha. Okay.
Because the bigger question is going to be, what's your interest rate, et cetera, right? It's not the payment calculator will give you an accurate payment, the same as like your phone can in terms of like calculating a mortgage payment based off of like a 6% interest rate and a $150K loan. Yep. Yeah. Laura.
going back to the credit versus income question for a minute. I always struggle with this one because I've been self-employed my entire life and always rented in New York and LA and just went through the ringer to had to have a parent co-sign for like my whole life basically. But always had excellent credit and sometimes had like 2 years worth of rent in cash, and offered to pay up front and stuff like that. So I always struggle with actually a credit score may be the better way to determine somebody's character in how well they pay. Cause like we had two very like $200,000-$300,000 earners in our long-term rental who as soon as they got fired from their jobs, one just pieced off and stopped paying and was like, come at me with a lawyer. And the other one, was not too far off from that. So it's like, as a property manager, how do you balance weighing like the exception and when to draw the line, I guess, or what makes one better than the other if someone can lose their job at any moment and just piece out on you the same as somebody who
Ultimately, credit, the score is just a score, but the maturity of that score can be so different. It's hard to value it very much. You could have a 18-year-old with 750 credit, but no job, and you're like, cool. Like what moves it is the cash, but credit helps me feel comfortable. When it comes to your expectations and what you will approve or deny, that needs to be very clear to every tenant to stay like legally compliant with fair housing. You can't just, well, this guy will work out. You can do that. There's a legal way to do that, and there's an illegal way to do that. You can't deny people just because you don't feel good about it. I don't like the check their car, go to their old house, call the old landlord. Like all those things are very old school, where now we have technology and can really verify bank statements. Like our application process, someone can go on and log into their banking, and our system will extract their income and like automatically qualify it as like deposits, and it'll do the math for me, and then I actually verify the math just to make sure. But ultimately, what I just want to get across is like, you can always go below your expectations. You can never deny someone that is above your minimum. So if your minimum, the best way to stay legally compliant with all these decisions is to have a really high standard and then be willing to go below it. But if you do go below it, you will need to give everyone an equal opportunity when going below your application process. So if you have a 550 credit that has been approved, below your 700 expectation, you would need to reach out to all applicants that would also be approved based on that variable. And it gets really complicated. To answer your question, I like income because it's what actually comes in, and I just would always choose that over credit because I might have a doctor that makes $200,000 and their credit is low, and that is exactly why they're going to pay me on my luxury $3,000 a month property, and they are not buying it.
Yeah, Lance.
And that's just a tough question, Laura, of like, how do we determine what someone's character like when something happens to them unexpected? I don't know. Like, oh, you thought they were going to stay together and then she lost her job and he dipped. Yeah, I don't, not to be flippant about it, but that's a tough one.
It would also be.
I mean, I guess it's more to like if is there any other metric that you would consider?
It does. You do need to talk into the mic, actually, for Dalton. Like, yes, every time we got talking to the mic. Like, we're recording this, and there's people at home watching, and they can't hear you.
Question being, maybe is there any other metric that you would consider besides credit score and income?
Not that I would feel comfortable with, because I want to always stay legal with fair housing law, and so those are some of the easiest ways to be equal across the board on approval. And when you have 390 that you're managing like I do, like it is something that I want to make sure the process is exactly the same every single time, so we're never discriminating against people.
I saw Lance. You had a question.
Yeah, so I can speak to that point that you just made about bad credit but has high income. That was me 13 years ago. I went through bankruptcy. It was not fun. And I sat in that seat, and it wasn't fun, but the property manager took a chance, said, well, you definitely have the money to pay me, but your, credit's in the 600s now because you just, ripped the guts out of it. And it was all part of the 2008 and 2010 debacle. So, and to Corey's point with regard to the advice you were giving Samir, the one type of property, I'm not calling you out, but I just know this because I'm going through it firsthand. The one type of property you guys didn't address is manufactured homes or a mobile home.
Sure.
Trying to get a loan on those. So I bought one and I'm renting it, and I'm in the process. It's on a hard money loan, but I'm getting it off a hard money loan onto a DSCR. Finding a DSCR provider for a manufactured home, it's not that easy. They exist, but there just aren't that many to choose from, like a stick and brick house. So just keep that in mind when you're buying houses.
So what probably helpful here right now, William, is when we're talking about the BRRRR strategy, right? BRRRR is I buy a property that has some repairs we need. I repair that property. I rent that property out, and then I refinance that property, right, to pull my equity back out of that. And so I need to have all of those considerations. That's why we teach this when we teach it in the year. We've already talked about how to estimate repairs. We've already talked about how to understand value. We've had those conversations, talk about the loan, to Lance's point. Like, before I buy these, do I have a clear exit strategy? Like, so I can avoid, if I have a clear exit strategy, I'm going to be okay. Daniel, anything else you got for us on the property management side while we got you up here?
As long as you're informing all applicants and making things very public on your listing, you can accept lower than your standard, and you can protect yourself with larger security deposits. There's a right way to do that and a wrong way to do that, but you can, ask for whatever the market wishes to say yes to. So if you want 2 months rent deposit on top of rent because the rent that you're trying to achieve is high and you're not able to choose from a selection of people that you feel safe about, but you want to approve somebody, you can do that. But it's all, what are you willing to risk? And so that's ultimately the only way to generate more leads is to lower price. But if you're having a significant amount of showings, you do not need a lower price. It's more of a closing scenario.
And I will say that Mark Beckett, that runs Grid with Rob, his advice is rent below market rate and pick the best tenants. Yeah. If you're
It's
willing,
really expensive, really quick, and hard to pencil.
Yep.
But very true.
Yeah. If vacancy is the enemy, like if you can rent below market, like you'll have more selection. So just whatever that is, not to be far, but just enough where I'm getting more just like multiple offers, having multiple applicants will put me in a stronger position. And what we've seen again is if you're an average person doing this versus a property manager, when you have more than one candidate, you are far less likely to make poor decisions based out of, oh my God, I've only got one. It's been a week. Maybe I should just do this. I don't
Operating out
know.
of fear.
Right? Like not having the stomach for it. Yeah.
Am I getting kicked off?
I don't know. Do you have a question for Daniel? Should we kick him off the island? All right, good. So RJ, Will, and then
Will's
get
coming.
you out of here.
So my question is, like with your farm or business, however you want to refer to it as, so you have
farm.
Well, you have to. So you have, you said 300 and some odd properties.
Yeah.
Obviously, not all owned by one individual, but do you have to have the same set standard for equal housing opportunity for your business as all of those, or can you have this is a different landlord or different property
Per unit.
per unit? Okay.
Yeah, it's the per unit. Typically, people let me do what I do best and make them money, so we just run with it with what I do. To be clear, actually lowered my credit standards probably 12 months ago because I realized competitors were also doing that, which is when we signed 18 leases just in the last 3 weeks on new leases. We renewed probably around 20, and because it's just the spring season and it's hot. And so you have to pay attention to what your competitors are willing to do. And when we have a property out near Loudoun, Lenore City, and I'm competing against A-Class. I have A-Class. They have on-site management. We do not. And so we are constantly paying attention to their approvals and their move-in specials, all the different types of fees they charge to move in, whether it be an admin fee or a pet fee or a one-time Wi-Fi bill. It's just the things go on. But ultimately, when I realized that most of these new construction apartment buildings that are being built around town, like the one my wife and I moved into out in Oak Ridge 3 years ago, they're taking anyone with a blood sample and wanting to put $115 down on deposit. So when you're in the private landlord sector like all of us, we want a whole month's rent for deposit and a first month's rent paid before move-in, and then we'll give you keys once that money is cleared. That's what you're competing against at the top, like hedge fund level.
They have very different incentives.
Yeah.
Like, I've got to make this thing pencil out. I've got to meet this sales target from this Fortune 250 firm. Yes. Yeah.
And so I don't know if that answers much, but it's just something to think about as a small landlord. And like we are focusing on income more than ever to get people moved in because of the lack of leads.
I will say this. What's the single, I'd have one question before we let you go. What is the most common complaint you see from people that are hiring you that were trying to self-manage? What's the straw that breaks the camel's back where they're like, I'm done, take this thing over?
They have a really bad vacancy. The last 2 contracts I've taken were from other management companies that were not getting the leases signed and the cash flow created. And they were slowing things down and not having a good sales cycle to get units ready and tenants in there paying.
Yeah. Which, there's a whole art to that of how fast can I turn a unit? Do I have a system for turning a unit? Do I have the vendors to turn a unit? Yeah.
Right now I'm trying to help about
I used to sell
2 if not 3 landlords not get foreclosed on and coming into the project at the very low end of the revenue of the deal.
Okay. Awesome. Thank you, Daniel. We appreciate you.
Thanks, guys.
My advice is always like, these people offer consultations for a reason. Daniel talked about the sales funnel. That's part of his sales funnel. Like, talk to them. Like, yeah. Like, but yeah, like rely on these because, there's a reason. It's because Daniel knows when I am sick of this, I'm going to call the guy that has been my resource. Why would I call somebody else? Like, I trust this person already for advice. So lean on your vendors is my biggest advice. Like, I see people in here and it's just like, why? I ask for help for everything. Like, why try to figure out anything on your own? What? Honestly, unless you just like enjoy the puzzle, I don't understand. It's got to be ego. Like, why are you trying to like be, none of what we're doing is original. It's not exciting. We're buying and we're doing residential real estate. Like, fantastic. Corey, so we talked a little bit about cash flow. How do things cash flow? We talked about how do I know if it's a deal? So let's actually talk about the BRRRRing out of it, right? The most exciting thing is, can I pull my equity out? Is it still possible? I don't know where Paolo went. Like, to pull this equity out, redeploy it, get free, Corey, I think maybe the most interesting question might be the last one there is a second question is like, is it still possible to buy enough assets where you're living just off of the cash flow from the assets? You got an opinion on this, Daniel, by the way? I know you've been on YouTube.
Yeah. I don't want to sell everyone and get into property management by any means, but when I did the get off the car lot, start wholesaling. I worked for Rebuilt, which is a local wholesaling company. Not sure if they're here or not. Like, still doing it.
I don't know if
but
they're in the market anymore.
I did about 100,000 in assignments 3 months in a row, and was like, all right, I'm gonna go do this on my own. And did it, generated quite a bit of revenue, but not that much because I didn't have the kind of capital to go behind on the marketing. And long story short, the concept was for 2 years was I'm going to wholesale into owning and being a landlord, and then call this and drop the mic and never be an agent or whatever. And the reality is the pencil was I'm going to need $2 million cash to basically make 80 grand a year in returns on mailbox money on solid deals. So you still need to be a multimillionaire to go build that. And then that's why I was like, man, if I take 10% off the lick and can manage these things, I'm going to make about the cash flow as if I am owning them, and I do not need to bring the down payment. And then now I do about just under $250,000 for myself and my management company managing.
And that's why we build cash machines.
I own one duplex, but that's it.
So, but no, that's why we build cash machines, right? If we're talking about like getting financially free from cash flow for Corey and I, like our real estate sales business is a very predictable investment. Like, and so that's why we look at that. So like whatever those margins might be, those sometimes are a lot easier ways to generate free cash flow than off of just residential real estate. The cash flow, I would say, for me is a bonus, right? But
Yeah. I would say
how many doors do you own, Corey?
5.
Okay. And what's the cash flow off all 5 of those doors?
$4,000 or so, like cumulatively across them all,
Yep.
like a month.
And how much capital have you had to deploy out of that $4,000?
A lot. A lot. Yeah, because I mean, if I really looked at them objectively, there's some that to that point. Okay, well, the first one, that was my first primary in Knoxville, by the way, that I then turned into a rental. But like, shit, that one has been a good cash flow in it. I pay $800 a month on a mortgage. It rents for $2,200. She'd be like, damn, like makes pretty good money, right? And I've put a new roof on it when I lived there. Since I turned it into a rental, though, I've had to replace a water heater. That was $1,600. I've had to repaint the inside. That was a couple $1,000. I had to replace carpet during like a tenant turnover because their previous dog like trashed it. So that's a couple $1,000. Just rebuilt the front deck here last year. That was another $1,000 or so. So even if I were to look at that cumulative cash flow of, okay, this thing prints out $15,000 a year in cash flow, like I've spent that in just the CapEx and maintenance of it. Like where it has made money has just been in the appreciation over time. It continues to get like paid down, and this kind of taps into Paul's thing a little bit. I'm now going to refinance that property and shrink my cash flow position because I can go pull out $60,000 like next week, and it would take me years. I mean, even just on that track, if nothing broke, it would take me like 5 years to make the same amount of money. So I'm shrinking my cash flow down. To Trav's question on like, well, what should I expect? That's like, this kind of goes like hand in hand. So I'm gonna riff on this for a second.
Yeah, please.
I'm shrinking my cash flow position down to $450 a month. So I went to my lender and I was like, hey man, like I know I've already got like a nest egg of cash set aside. I've got like $10,000 just in reserves for this thing still. What's like the most amount I can pull out of this, but still keep like $450 a month in like cash flows, like my spread. Because I'd rather take the money out now, tax-free. I can use that for other stuff. And when I want to go, say, sell that in a couple of years, I'll pay less in taxes on that remaining spread. There's going to be like maybe another 50, 60 grand in money still like left in the deal. But I can pull out 60 grand next week, like tax-free as a cash out refinance. And I can go put that money to work elsewhere. and I've already done the big fix ups right to that point. Like, okay, cool. I just put a new roof on it. It's got a new water heater in it. The HVAC the previous owners had put into it right before I moved in, and it's a 1990s built house. So my big stuff is largely square for the foreseeable future. I'm gonna have to do a tenant turnover or something like that, but that's not as much in the grand scheme of things. And I have that cushion of reserves now to do that. I've got 10 grand and that 450. My wife and I agreed we're just not touching it. Like that's just going to keep saving itself, and that's that.
So I think one of the interesting things to think about if we're talking about how to buy and hold is it really comes down to some questions about strategy. One is risk tolerance. Two is what kind of noise you're willing to tolerate in that process. Hey, am I going to do some of these repairs myself? Am I going to manage contractors? To what level am I comfortable managing contractors or repairs? To what level am I comfortable dealing with, property management, dealing with tenants, like being in that world? That's going to determine like what I want to do. Everyone is selling single family to get into multifamily. Multifamily is interesting, right? Like multifamily seems like it might be simpler until you go there and someone is selling drugs to someone else's girlfriend and she's sleeping with them in exchange for the drugs, and then he finds out and tries to burn the unit down, right? And then you have to get the guy out, and you have to go, and then you have to try to keep the people that are understandably freaked out by this, and it involves like if you're going over there and spending time with people in the evenings, building some relationships, selling them a story of how I'm changing this unit and you should stay, and then getting some wins, like I can go deeper on this, but it's more complicated versus having like a single family, which is its own entity. It's not, there's no chain reaction of like one bad tenant starts affecting everything else in this unit, right? So it's being kind of realistic about what do I want to build long term? What's my strategy? Do I need cash flow? Do I need appreciation? Right? I love what Corey said there. It might have been subtle, but like when we go pull out debt, it's not a taxable event. When we go sell this asset, we're going to pay capital gains taxes on there. What's the capital gains rate that we're going to pay on selling an asset? Like 30? Is that
20? I think it's like, I thought it was like 20% on like a long-term capital gain.
32 is the number that I thought. Yeah, what house hacking we're talking about is if you live in if you sell a home that you've lived in 2 of the last 5 years as your primary residence, as a single person, you have a capital gains exemption of $250,000 in appreciation. If you're a married couple, you have $500,000 in appreciation. Pretty sexy. So like that can be huge for you, and it's tax free. That's why real estate investing gets so exciting. It's just like the compounding effect of the tax advantages can be really helpful if you make the right moves over time. So thank you. Okay, that's what it is. So if it's short term, it is 37. Short term is that short term like less than 2 years?
No. Short term is less than a year.
And then between 1 and 2, I think there's another rate there, but Okay. Gotcha. So if your short term capital gains or if I'm flipping something, I'm paying 37% active income. Something else to think about. Flipping's really sexy because I just made $50K on this flip until I realized at the end of the year I didn't set back 37% to pay for taxes. See Lance smiling.
Yeah, and
that is a man who's done a lot of flips.
It is. It's very much like a strategy. It's just a strategy plan, you're right, to what you want to do. Because some people would look at me like I was crazy, right? Like, what do you mean this thing's cash flowing like crazy and it's a sub 3% rate? Why in God's name would you ever do that? Well, I don't plan on keeping it forever. It's a cool house and it's made pretty good money, but it's largely appreciated a lot because I bought it in 2018, 2019. So good on me, right? I bought a house before COVID. But it's max. It's like pulling out to that point. Like it's only going to appreciate like so much more like per year. So I would rather take the money out now at a non-taxable spot and I can pull out 60 grand tax free and not have to pay 20% on the 120 grand I would have made if I sold it. I can just pay 20% on the 60.
But the reason why, and I want to be very clear on this and not to toot Corey's horn, but the reason why that makes sense, the reason why you see Grant Cardone or somebody saying you should rent and do all these other things, if you've solved the deal flow problem, if you've got all kinds of deal flow and your constraint is capital, man, I keep seeing stuff, I want to go after it, or I've got projects, or man, I'm funding renovations right now and getting like a 10% return on my money, yeah, then these things make sense. So we're talking about redeploying the capital. To answer your question, those can be really effective if I've built a cash machine where my cash machine, I'm good. I know I'm paying all of my bills and I've got some leverage in my reserves that I can get kind of aggressive in how I'm like rocking out all this equity. If I don't, then I'm just building this like house of cards that's going to come down, a la the gurus we were talking about earlier, like go buy all of these doors. To be clear, in the real estate space, all of the young entrepreneurs I know that are also agents that I get to meet traveling around the country, young kids that are millionaires, let's say 30-year-old millionaires, selling their doors. Because it's too big of a pain in the ass. Like the juice is not worth the squeeze. And these are guys that have 80, 100, 200 that did it. And they're like, this is not, I wouldn't say all of them, many of them are selling those doors because they just like, it's not worth it. The amount of noise I have in this one aspect of my business versus these other aspects, the opportunity cost is too high of like just stacking all those doors just for cash flow. So I'm curious, we got a couple people in here. Parker, you own some doors. Like, tell us a little bit about what your strategy has looked like. And, are you cash flow based or appreciation based? What's been kind of your philosophy?
Yeah, pretty similar to Corey. But we basically, my wife and I did house hacking without the tenant. So we would just move into a home, live there at least for a year to meet the owner occupancy clause, but then move out and then rent that one out. But a lot of that, I think, strategy has also come from whatever the lender tells us we can qualify for, we go way below it. Because especially going from the first one to the second, before you have the rent. Now, of course, if you're actually house hacking and have a tenant with you, then you get to count that income for you. But if you don't have the actual tenant with you, that second home you have to qualify for basically 2 mortgages. And if you choose to live below your means, it makes it a lot easier to qualify for that second mortgage.
Yeah, you didn't get yourself in a cul-de-sac where like, man, what I qualify for on paper is not the same as what's penciling out, which is, that makes sense. So you've done that. And how many doors do you own now, Parker?
5.
Okay. And how many years did it take you to do that?
6.
Okay. So that's another very simple play. Like it does not have to be anything exotic. It doesn't have to be in like if you haven't talked to Parker about money, talk to Parker and Mary. They got some really great tools. These free tools they developed, like money lessons. It's a really cool suite. Parker's one of my favorite guys in the room to pick his brain about this stuff. But yeah, it can be that simple of just like we're willing to live below our means. It's the whole, what is it, the Dave Ramsey? Like if you're willing to live like no one else, you can live like no one else. Yeah, if I'm willing to go do this for 6 years and move 5 times, like I can have some doors. And then were you focused on cash flow? Or do you focus more on like for rentals? Do you focus on, hey, limiting vacancy, getting really stable? What's some of your philosophy there?
Probably more ultimately appreciation.
Okay.
We definitely cash flow just for the sake of being able to cover repairs and everything of that nature, but we don't live on any of that money.
It just goes into reserves.
Yeah, 100%.
Yeah.
It's just preparing for whatever the next thing.
How many months of reserves do you like to have for each property?
We're aggressive in this, or I guess really conservative in this. We hold 12.
All right. Never go broke being conservative. Make less money, but you're not going to go broke. I love that. I appreciate that, Parker. And then Rashid, you got some doors. Tell us a little bit about what your strategy's been like, what your portfolio looks like.
Okay, so I started out in 2018, single family, the BRRRR method. Like he said, it pre-COVID, so it was awesome. Ride the wave. Focused on cash flow, and later on realized that it was more about equity. So now I got 18 doors now. So now my thing is, long as the rent covers, it's more of a long-term play. And now, like in the last year, location is like very important because the wave of appreciation is a lot better. So that's where I'm at now.
How many for you? Because you've got 18 doors.
Yeah, and I self-manage too, so I'll be hollering at this guy.
What does your reserve position look like, Rashid? What does your reserve position look like? Like, have you been able Meaning like, hey, if I got 18 doors, do I need to keep 6 months reserves for 18 doors? Or is there some amount where I'm like, I got a little flex?
The goal.
Yeah.
The goal is 6 months. Do I be there all the time? No.
Yeah.
Because stuff like, especially summertime, people swear their unit don't be working. And it's like, my unit's not working. Everybody's unit be brand new. But, so the goal is 6 months. Under that, if I get like across the portfolio under 3 months reserve, my check engine light come on. So
Yep. What I was told by this guy, Ben Kinney, that owns Place, was his rule of thumb, pretty conservative guy, was 4 months. Because he's like, 4 months is like 6 months because you're going to make a move. You'll drop the rent. You'll do something. Like, you're not just going to sit there and let it sit vacant that entire time. And that's been a good rule of thumb in my head for me, But, yeah, it's fantastic. Thank you. I appreciate that. Right?
Yeah, like 6.
Yeah. Corey, who wants to talk about what's actually working right now in terms of BRRRRing, right? So the whole idea behind BRRRRing, like, would be, hey, can I go buy a property? Could I go renovate it? I renovated it enough that the ARV goes up enough where I can then go cash out refinance, pay myself back, and have no money in the property. Then I can go rinse and repeat. I have some friends and a friend in Vegas, he did this. They pulled together $200,000. They went and they bought properties with a commercial DSCR loan. That's a debt service coverage ratio loan based off of the proposed rental income of the properties. And then they bird these things out because they got smoking deals on these, right? Just did some basic fix-ups, pulled it back out. He bought 7 houses with the same $200,000. Now, what's under the hood there is Andrew is one obsessed by this stuff, got out of real estate and became a financial planner because he just is like obsessed by it, was working with financial planners. And Andrew was willing to write like 100 offers to get a property. There's no free, there's always something of like, you find out, oh, there's the grind. Everyone's got the grind. Oh, Rashid's hitting those numbers. He's self-managing 18 doors. Yeah, but that's exactly. So you just like, there's it sounds great. And there's I'm self-managing 18 doors. There's a reason why Daniel makes his 10%. Like it's a job. It could be a full-time job. No, fantastic. Corey, what do you see that's the idea is, hey, can I pull that out?
Yeah.
What do you think works right now in this market? What are we seeing people do that works? We just talked about one of these that was like a pure.
Yeah. Well, so certainly I think there's something to say for just the volume play. Like, are there opportunities? Sure, you're gonna have to send out a lot. You're gonna write that 100 offers to get something there. Strategies that I'm still seeing working now. I mean, certainly now more than ever has been. It's still kind of in a BRRRR, but it's just the build, like a build to rent, has been huge for a lot of people. Able to come in, they can build anywhere in that 130 to 170 a foot building, single family or like small multifamily is where you see some great margins there, where somebody can go out, they can build a small duplex. It's going to be worth somewhere in the ballpark $500,000, like on the exit. You can refi out there at around like 400, and some of these properties, I mean, they're gonna cash flow. You're gonna get close to $2,000 a month per side out of those on just like a long-term rent. We're seeing a lot of that happen around downtown. And that's probably one of the best opportunities I'm seeing.
We're also seeing some deals that we were just looking at one of these where the equity position based off of some of the local builders that we work with, this guy's going to be an 80% loan to value. So what's going to cost him to build this is going to be 80% of the appraised value when it's done, and he's going to be able to pull his cash back out. Like we are seeing that. So I think that's one of the biggest areas of just like building to rent makes a ton of sense to us, because when I look across the landscape, we've got a lot of ticking time bomb inventory in Knoxville.
Truly.
Right? When I look at plumbing and I look at electrical and I look at the complete lack of code enforcement, like total cost of ownership, I'm pretty bullish on newer construction, just because the tenant I can attract to it, my total cost of ownership, it's just a much more predictable. I can do continuing maintenance, like scheduled. That's a much easier thing to control. When I get responsive and I get reactive, I don't know about anyone else. Like crisis is only happy when I'm on vacation. That is just how this thing works. Like whatever can go wrong will go wrong, right, Corey?
Yeah, no,
like
truly.
it just is.
For sure.
Like,
yeah, I would say
The
that
toilet breaks on Memorial Day weekend. It does not break.
a lot of my conversations with out-of-state investors that say live in maybe some of these higher income markets, call it around the D.C., Maryland, Virginia, like Mark in particular, was just having this conversation with somebody. We really like outlined a buy box. Like we're not buying anything older than 1990 for just that pure reason of the cost of ownership is going to likely be that much lower. Where as long as your big, say, MEPs are square.
What's MEP?
Mechanical, electrical, plumbing.
Didn't heard that before.
If
Cool.
those are in good shape, you're likely going to be in good shape. You know, from there, you're just going to look at the roof, the water heater. Where is that sitting? If you can get some of that negotiated in as part of your deal, you should largely be good for quite some time.
So, side note, Lance was amazed that I had an MEP in real estate. There is jargon for everything, and everything is there's like 5 names for everything.
Yeah, totally.
So just if you don't know, don't feel bad about it. Like things have like multiple names. Same in construction, they'll call the same thing 3 different things. I don't know why it's this way. I see everyone nodding. It just is. So if you hear some jargon, just you're not. Sometimes it's. I still am learning new things. I'm like, oh, okay, that's we did not call that in the last. No, I'm not. No. I just mean like you. I still hear new things. Is all I'm saying. Like so, if you're new here and you hear new things, it's not like a lack of knowledge. Sometimes, like things get called a million things.
Yeah.
Nathan, Morgan, since you're in the room, what does anyone have questions on we haven't talked about? Yes, Paula.
Okay, so if you buy a property that's old, right?
Talk right into the mic.
If you buy a property and this property needs to be renovated, how much renovation do you do? Is there something that you can do too much, or too little? If you're trying to increase the thing, the value, yeah, pretty much. Like, where's the sweet spot? What would be your advice?
What's my sweet spot on how much to renovate a property? Okay, so I think really what we're asking this is so we talked about 4 levels of renovation. If we're renting, so really if we're talking about the difference would just be if I'm going to frame this, here's I think the question you're actually asking. It would be like, hey, if I'm going to go flip this thing to someone that's buying it, that may be a very different market that I'm exiting versus what level of repair should I do if this place is going to be a rental? Like, and where should I spend the money, and what are the things that are appropriate, right? I'll start off and let Corey go there. One, keep in mind you can have 2 different renovation strategies. There are things that I could do I could partially renovate a property with a goal of like I want to be able to hit a certain price point in the market. Adrian Smood came to Knoxville's Best one time, and he said he buys these really beat up looking trailers, and he does as little as possible, and he rents them to contractors. But the reason he does that is because he's able to actually rent for less than $1,000. So he serves a market that no one else can do it. And he said if I renovated these things totally and made them look okay, like I wouldn't be able to like the minimum rent that I would charge. It wouldn't make any sense. I wouldn't even be able to serve this market. Instead, I rent this to somebody that's capable of taking care of some of these property themselves, so it's not a big deal. They can do some of these things, and they don't care about the cosmetics. Like, so that's based off of the rent. That's one of the ways to do it. Could be, I could work the budget backwards based off how much money could I put in there and what's the rent that I'm going to exit. Another one could just do if like, hey, when I go to sell this, maybe I'm going to put the granite in or something. But there's a level of repairs that I'm going to do right now. Maybe I'm going to address my plumbing and my electrical, but in terms of my finishes, I am going to put in some tenant grade finishes, and then I might do, I'm going to add the crown or something. There's another renovation I could do as an exit strategy down the road. Or if that market changes, right? Anybody like Park Ridge? I lived in Park Ridge a decade ago. There used to be crack prostitutes on Olive. Like, so if I went 2 blocks that way, it was rough. Me and my daughter went the other way, it was fine. It is a very different place now. I can do a much higher level of renovation now because it's going to be supported by the market.
Yep.
What are your thoughts, bud?
To this point, like fix what's broken. I don't buy anything to flip I wouldn't otherwise like be willing to keep as a rental. So it has to pencil like both ways. Like that's one of my rules of anything I'm picking up to flip. Like if I can't for whatever reason exit on the flip, it has to be able to cash flow as a long-term rental. Not even getting creative with co-living or any like niches. Like purely I'm just putting a long-term tenant in there for 12 plus months. That has to make sense. From there, then I'm looking at yes, what is the neighborhood support? What are other rentals in the area offering? To his point, like go look and see what other inventory is out there. My last flip I just did was this property, split foyer on Cadbury, and some of you went through this property. I famously really didn't do anything in the kitchen, did I? Like, nope. Kept the cabinets where they were. It had laminate countertops. I was like, that's fine, because for where the price point's going to exit, it's going to be like the low 300s. That person's not really going to care that it's not granite. And I still spent money. In other words, I had to put like a new electrical panel on there. I made some other things nice. I put a nice like tile shower in the bathroom. But I did just this. Like I kept it mostly carpet or vinyl. I kept a laminate countertop in there. I can always switch that out later if I really wanted to. I could always switch it out to granite if the thing moves. I was really just wanting to make sure that this thing was like safe, stable. I fixed up all the big stuff, polished up the rest, and then sold it to exit. But it totally would have worked for me as a long-term rental as well.
And, you know, basically it's pretty simple. I'm looking at durability. I'm looking at functionality. I'm looking at cleanliness. Would I live there? I am pretty open-minded. I've lived almost anywhere. You know, I live in the hood now. I live in Mechanicsville. Like I can walk to Water Angels. It's 2 blocks over where they feed the homeless. Like that's my backyard. So like would I live there? And if the place is functional and it's clean and it's reasonably, I would. I'm not as concerned about some of the cosmetics. What I'd be curious about is Daniel, what are you seeing moves the needle for tenants? Because if I want to get tenants, I would say sometimes tenants make dumb decisions. So people will be renting shit because there's granite in garbage places. In my experience, I've seen some places where I'm like, they got bamboozled by some appliances and some granite.
Man, I thought you were coming at a different angle. Honestly, right now I had to fill up 60 units, and I'm like 25 in less than 12 weeks right now, and I hate to bring it back to the move-in, but move-in special, like making the cost to move in right now, we are all tight. I don't know. Like America's tight right now. So if you don't want to do a renovation and you want your unit filled, you can take the risk on a lower security deposit, or another conservative thing would be a free second month rent. So you get a deposit and first month's rent, and then that second month would be free. And it's making it where people can leave where they're renting right now to come to you, because they're living month to month. So if they have to give you 2 months, they're unable to do it, even though they're good people that want to pay.
To that point, too, the other thing is just looking at, like, I'm selling a duplex on Parkview. The tenant's been in there for 5 years. So, like, you don't have to do anything. You could just buy it and continue renting it at the same exact rate, and they are fine with the way this thing looks. And, like, that outlet's kind of jacked. For them, because of the safety, the convenience, the bus location, neighborhood, there's other factors that may be driving that. But it's a good question.
Our team focuses on keeping expenditures low, to be honest. Most landlords want that cost annually to stay low, so we do the minimum needed to keep places safe and livable and presentable during the market.
And there's 2 different strategies. So Jason McDaniel, everyone knows Jason, he co-founded Knoxville's Best. Jason's strategy on all those 40 owner-occupied properties was he is going to fully renovate them. He's going to put in granite. He's going to do that and just get it all done at once and then lease it out to like a nicer tenant. I have seen other people where the goal is, hey, I could buy this thing. I could stabilize it. I could get somebody in there. And then down the road, I could decide what level of renovations that I want to do. And again, functionality, cleanliness, there is a place in the market. I don't know if anybody else was broke and lived in some cheap apartments. Like, you know, I was having great water pressure was more important to me than what kind of fixtures I had. I was like, that went a long way. I was like, cool. Is this, and anything we didn't. Yeah, it just and that bathroom
Trav.
fan. That bathroom fan. Change that cheap,
Yeah.
terrible, loud bathroom fan. Oh, just. Yeah, that's also
not-
true. Don't go
not
too quiet.
too quiet.
I've gone the other way where it's too quiet and you got to run the water. I've learned that lesson because I'm a fanatic about this. And then I was like, I did it. It's too quiet, and like now you can't go to the bathroom off the living room. Like it's a problem. They do play music. Yeah, yeah. I put some Bluetooth. It's fun, man. It's fun.
So,
Yeah.
Yeah. So, a lot of people talk about this 70% rule. Is that still a good guide, or is it 75, or is it 76? Like where is it just strictly a personal opinion, risk tolerance, or is it something like what is there? Is there just like a new trendy guide to go by instead of just a 70% rule?
70 is typically applied in like the fixing and flipping space because you're going to have like some unknowns and some extra like margin to be accounted for. I typically am anywhere like between 75 to 80% because more than likely a lender's going to, they might give me up to 80, but like 75 is definitely going to be like a sweet spot for me in terms of like that cash out refinance. So I'd be using that 75 to 80%. And like there is there is a point to look at it as well. If I can't get all of my money out of it,
Yes.
let's just say like, okay, well, I don't get all of my cash out of this thing and I leave 10% of the after repair value like in this thing. And so I've got 20, 30 grand tied up in this thing that it's worth like $300,000 and it's rent, like it's cash flowing just fine. Awesome. I now have a turnkey asset that I got for effectively 10% down. And then that's good for me because I'm going to play based on yield over time. It really depends on like what game am I playing. If I'm just playing this long-term hedge,
Right.
cool. I have properties that are just that I've left money in it that I left. Yeah. 10% of my ARV down and like, that's fine. It
And if I'm
appreciates, it pays
chasing
down.
equity positions, like the goal is to pay down the principal. You're not losing just because you're not redeploying all of your capital. Like more is not always better. I have a friend to the point like that goes to the Tampa location. He's an attorney. He's like, yeah, my strategy is just like I make enough money and then I buy another asset, and then I sit around and we save, and then like next year I have enough money and I buy another asset. Like it's not sexy. It is just like when I have enough of a down payment, then I can go buy something else. And he's just collecting properties. But great question, Trav. And some of this comes down to like rent renovation. It all comes down right to fundamentals though. Like if a deal is a good deal, it's fantastic. If we're not buying good deals, they're not going to like make sense magically
Yeah, it's not just gonna
on the back end.
Turn out for yourself. Yeah, it's not going to change.
If you want to do some sexy stuff, we should have a conversation about new construction. We're going to be talking about new construction in detail later this year. There are a lot of very interesting opportunities in new construction. So one is just the delta of if you know the right builders that we have, where I can go build and have instant equity. The other one is just looking at zoning and getting creative with development and rezoning of like, can I go buy properties that come with additional lots or subdivide lots or right where we've seen people really be able to get equity and delta there. Like, so that's the stuff I would really look at if I was trying to be aggressive and creative. Would be the new construction stuff right now.
Yeah, that's a great play.
Yep.
Great play in this market, especially too because that point like
infill subdividable lots.
Yeah, you're right.
I'd be looking at the city right now based off of like the county's going to
rezone.
So who knows how that's going to shake out?
But like to your point, we have a lot of. That was a great line of like taking time bomb inventory, and if I can just go build and it's gonna be great for the next decade. I don't have to worry about it.
Yep.
It's a great play right now. There's a lot of we will turn the corner at some point within the next couple of years where you're just going to see more and more of the tear down of those homes and the numbers will start to make a little
it's
bit more
going to
sense
make
for
more
people.
sense financially to tear down this stuff
To just
inside the
tear it
640
down.
loop
Mhm.
and rezone with more density than it is going to be to repair these things.
Yeah. There's a few builders right now that are already
That's what I
moving
see in
that
Tampa.
direction of buying that old Craftsman on the corner, the big corner lot, and they may look on paper like they're overpaying for that house, but they tore down the Craftsman house and they paid $300,000 for basically a tear down house, but then they go build 3 duplexes on it, and they just sold each duplex for $500,000 a piece, and now they look like a genius.
Yeah. So
Yeah.
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 And this is a great way to close it. This is why I love running an investing community. I love you being here, is because like everyone here has valuable information. When we collaborate, we're like, oh, yep, that's what's happening in the market. Those are where the opportunities are. Any final words, Corey? Anybody got any questions? We're just hang around. I think we kind of ran long enough. I will share. So Grid Tactical Tuesday, just so you know, every Tuesday at 11 a.m. Next week, we're going to start. I'm going to be interviewing Rob Chavez. He's going to talk about the 7 levels of freedom. 7 levels of freedom are just our framework to run every business that we run inside Grid Capital Partners, right? Of just like, hey, here's the base level energy, identity, mindset. Here's the predictable income. How do we zone a market? How do we build a cash machine? Level 3 is going to be business ownership. Do you have, and this is going to be great for like our entrepreneurs. We've talked, Will, like, hey, do you have a people playbook? Do you have a marketing playbook? Do you have a sales playbook? Do you have an operational playbook? We know that that's like the boss operating systems that run all of our businesses. We're gonna go detailed in those things. So yeah, if you want to join us, I'll send this out to everybody. But you are all invited. Invite everybody else you can think of. Yes, Lance. Yeah. So great question. Those calls will be recorded. They are going to live inside of like the Grid Pro world. So there's a paid membership coming out on the national level. You can catch them live for free. All of the playbacks from all of our stuff is going to go live in this Grid access where you're going to have access to all of this information, this education, and these courses. So just throwing that out there of like, we want to be really intentional of like giving you stuff that's going to help you sequentially build. Thank you all for being here. Corey, any last words for us?
Yeah, just would love to see everybody here at our next upcoming events. Next month, we're diving into commercial investing. We've got Aaron Thomas coming from Grid Cleveland here into town.
Aaron Thomas, I think, is literally maybe, from my perspective, one of the best commercial agents in the entire country. Cleveland has an absurd amount of multifamily. I mean, a stupid amount of multifamily. So she's the only person I know who's like, I just sold a 17-door and a 30-door and a 20-door. Like, just knows this stuff ice cold. Has worked with Keller Williams Commercial like on a national level, teaching and instructing, and she runs our Grid Cleveland community. She's awesome. She's going to come in here. We've got Ruben Kanya coming later this year when we're talking about midterm rentals. Ruben's been interviewed on Rob's podcast, the Income Flip podcast. Go on YouTube. You can check this out, or you can go Income Flips on Spotify, all those. I think Ruben is the best midterm coach in the country. Known Ruben for years. So if you want to know how to do midterm rentals, we're bringing him here for some experts. And we've got a couple events coming up this month because we're maniacs. So we've got Intro to Real Estate Investing 101. We've written this entire content. We sat down and rewrote everything with Trav and I. I think it's fantastic. So if you don't have a strategy, come join us July 11th. We've got Coffee, Donuts, and Deals. That is going to be July. This one says June. That is the third
Friday
in July. I think it's the 23rd, maybe. I don't know.
Sounds pretty close. I'll verify.
17th. Yeah, I'm just making stuff up. 23rd sounds good. And then that might be Grid Smokies. We have Grid Smokies. We've got, his name's Johnny Amusement. We've got the #1 Dollywood influencers coming to Grid Smokies. If you haven't been, if you're interested in SDRs, that'll be really cool. It's located in the Pines in downtown. And the last Wednesday, we are doing an event at Aspire. So from 4 to 6 p.m., we're going to do an event at Aspire. If you haven't been out to Aspire, come out. We're going to talk about economic development in Anderson County. So here's just to lay the scene for you. There's a growth moratorium in Blount. There's a growth moratorium in Loudoun. Knoxville is rezoning the entire county right now. And then Anderson County has thousands of jobs coming with the nuclear industry. So we're going to have be up there in Clinton. Clinton has a 5-year growth plan. The head of the Clinton Utilities Board is going to come talk to us about that 5-year growth plan. I believe Rick Meredith from the Anderson County Chamber of Commerce is going to come join us. So we're going to have a conversation about, one, you need to come check out Aspire because there's a 300-acre park up there. It has totally changed my perspective on investing in Clinton. was able to just go in and flip, and I really sold to that. And we were able to like exit the market. We're seeing people like move there, and it kind of changes the value of the property in downtown Clinton. And just if you look at the growth, if there's a moratorium in Blunt, there's a moratorium in Loudoun, they change the zoning, and where are all these jobs going to go? Clinton's 15 minutes away. It's either there or Roane County. There's no other place for all of this growth to go. And so we're just going to have that conversation. That's going to be the last Wednesday, and we're going to charge a ticket price like we did before with our Barley's event, if anyone came to that one, the stadium tour, and make a donation to charity. So we'll have some drinks, have some apps for you, and we'll raise it, raise $1,000 or $2,000 for Second Harvest. All right? Excellent. Okay. And then Dalton says we have to take a photo. We're all done. Thank you all.
Cool. Thanks, everybody.